Hi, everyone. I'm Caroline Zakari, and I work in the Office of Civics and Community Services here at the Los Angeles Public Library. Welcome to our Know Your Housing Rights series. Today's program is called Homeowners Know Your Rights and is brought to you by the Housing and Economic Rights Advocates and the Los Angeles Public Library. Today, Megan Grimm from HERA will discuss the complex landscape of homeownership rights and responsibilities in Los Angeles. She will cover crucial topics like loan modifications, adeptly navigating HOA complexities, effective dealings with servicers, and essential strategies for preserving your home and steering clear of foreclosure. Additionally, she will delve into managing property taxes, providing you with insights on assessments, exemptions, and smart strategies to keep your financial obligations in check. We will have a brief Q&A after the presentation, so please send us your questions throughout the program. Thank you, and take it away, Megan.
Thank you so much, Caroline. Hi, all. I'm really happy to be here. I'm really happy to be speaking about such an important topic, especially in this current landscape, homeowner preservation. Everything about how to keep your home afloat, how to keep your finances in check, and how to make sure that you're acting responsibly, the lenders are acting responsibly, and everything's going smoothly here. It sounds easy enough, but here's what we have. We have your mortgage, which is different than your property taxes that you pay. Then you've got your homeowner's insurance, another cost to consider, escrow accounts, HOA or condo fees, if applicable, and maintenance and repairs. So when you're thinking about buying a home, if you're thinking about buying a home, there's a lot more to it than just thinking about your mortgage. You want to make sure that you have room in your budget for all of these things. And when you're thinking about taking over a home or when you have a home, you're going to keep all of these things in check and keep them in mind. So let's start with the basics here. Mortgages 101. Very simple overview, but we're going to start from basics. What are the relevant documents? So we have our promissory note. This is the contract that you sign. This is going to have your signature at the bottom. It's what you're agreeing to. You could be agreeing to exactly how the length of your mortgage, how long you're going to be paying it off, who you owe the money to, and for what length and period of time and what interest rate. And then you have your deed of trust. This is recorded locally, and this is exactly what tells you or how you show proof that you own your property. So those are the two most important relevant documents that you're going to have. And then we say, who are the players? This seems a little simple, but I get calls all the time where people think that their servicer is the person or the entity that is also the person who owns their loan, and that's not the case. So the servicer is going to be the person servicing your loan, the person you're making payments to. It's going to be the people that you speak to if you need a deferral or if you're falling behind. And that is not going to necessarily be the person who owns your loan. That could be a bank that's an entirely different entity, and most likely is going to be an entirely different entity. And then we have our principal balance, which is how much we have to pay off, our interest rate, which makes a really big difference in your monthly payment, and the amortization period, which is the length of your loan. Other things to consider is whether this is your first or second mortgage. You always have the option to take on a second mortgage, which is another separate monthly payment, but it's a way for you to get additional funding. There are also purchase money mortgages, which is another way of saying seller financing. So a lot of times if you are purchasing a home, but you may not qualify for a typical loan, you can kind of work with the seller to provide the finances themselves, seller financing mortgage. There's also hard money loans. These are more short-term loans that you're dealing with most of the time a private lender. You also have HELOCs or home equity lines of credit. These are agreements that you have or a loan that you take out, which is a smaller amount usually than your mortgage, and you're pulling it out of your home equity. Then you have your primary residence. This is the place where you live, and balloon payments. This means that you owe a bunch of money at the end in order to bring it current. Those are just things and terms to keep in mind as we go through. So we have common mortgage servicing issues. There are several things that can pop up and often do pop up when dealing with servicers, when you're trying to consider things where you're making sure that your lender is acting appropriately. And the first thing that you want to think of is dual tracking. This is the most common complaint, and this is actually against the law and the most common illegality that we see here. And if you don't know what dual tracking means that while they're trying to work with you and preventing foreclosure, say they're considering your modification application or they're considering a refinance, at the same time they're working towards foreclosure. This is completely illegal and it can't be done. So if you ever have evidence or a sense that foreclosure was happening at the same time you were pursuing options to keep your mortgage, then this should be reported and you can have a remedy. Other servicing issues pop up in escrow shortages. This is when you don't have enough money in escrow to pay property taxes or home insurance. A lot of time funds from this escrow pot, are not in the appropriate place, and it could lead to an escrow shortage. Also, loan transfers. Your loan may have transferred to a new servicer and you don't get proper notice of this transfer, and there you're unable to make a payment or you're not sure where to make a payment. If this happens to you, then that could give you cause to take action. Then we have requests for information, notices of error. So these are two formal documents. They're written letters. And if you go on a servicer's website, you're almost all of the time going to easily find a contact information, email or address that's just for these two things: requests for information and notices of error. That's because by law, they have to respond to these two things within 30 days. A request for information is a formal written letter where you're just requesting information about your mortgage. And notices of error is when you found an error, there's an error in calculation, there's an error in some way they've been managing your mortgage, and you want them to address it and investigate it. They have to respond to these two things within 30 days. But it really helps to make sure that you're sending it to the specific addresses and the specific email addresses that a lot of these servicers provide on their website. Forced place insurance is when you don't have adequate insurance according to your contract. And so the servicer will go ahead and sign up insurance on your behalf. Oftentimes I get callers saying, I have insurance. I don't understand why they went and signed up insurance for me, and now I have an extra charge. Well, you have to double check. Does your insurance meet exactly the qualifications that you agreed to when you signed up? Misapplication of hardest hit funds or reinstatement funds. Every state has hardest hit funds, and they're funds that are for the specific purpose of making sure that homeowners have assistance when they fall behind. And if you have any inclination or evidence that your lender may be misappropriating funds, that can give you a cause of action as well. Loan modification incentive payments. These are frequent scams that we see. So if any entity, not just your servicer, but an outside entity contacts you saying, hey, I can help you get a loan modification, just pay me, $1,000, $2,000, whatever it is. This is an illegal scam that we see often. Doing a loan modification is free. You just fill out paperwork with your servicer after contacting them. But there are a lot of scammers online that will offer to do it for you and promise to get you caught up in your mortgage or to lower your mortgage payment as long as you pay them money. And this is illegal. There's also wrongful credit reporting of pay status. If your lender incorrectly reports that you're behind or you've missed payments and that's not the case, then this can also give you a cause of action where you would be able to remedy that. And periodic statement rule. A lender can violate a periodic statement rule by not providing a statement at the end of a billing cycle. And so if they're not providing you a statement with the status of your mortgage, exactly where you are, how many more payments you have, then that could be a violation as well. So I know it's a lot to take in, but these are the most common calls and the most that we get and the most common errors that we see with mortgage servicers. And there's a lot of rules that they have to follow and they don't always follow them. So it's good for you to know your rights as a homeowner and know what you're entitled to so that you can fix it and advocate for yourself. So each of these things can turn into a foreclosure risk. So not paying your mortgage will put you at risk of foreclosure. property taxes, including PACE assessments. If you don't pay those two things, that could put you at risk of foreclosure. And just briefly, PACE assessments. Not everybody has a PACE assessment. You would, unless you're taking it on after buying a home, you would know if you had a PACE assessment because you sign up for them. So a PACE assessment is often what you hear about when they're like, okay, someone comes to your house to sell you a satellite or sell you new air conditioning or what have you. And it puts a lien on your property, and they'll tell you, okay, this is included in your mortgage amount will go up, or it's included in your property taxes will go up X amount. And so you just think of it as an extra bill. But the differences between this and a typical credit card payment is that your home is actually what they're leveraging to get these payments. And if you don't make your PACE assessment payment, even if you're caught up on your mortgage, you can be foreclosed on. So it's crucial to consider that. If you're purchasing a home that has a PACE assessment lien on it already, meaning you're taking over that PACE assessment lien from the seller, you also need to be mindful of that, because if you don't pay the PACE assessment, then you're putting yourself at risk of foreclosure as well. Homeowners insurance, this is something that you also have to pay. If you are required in your mortgage to pay homeowners insurance and you don't have it, then that can put you at risk of foreclosure, particularly if it's accounted for in your escrow, and that way you're behind on your escrow account. This is a surprising one. A lot of people that I speak to do not know this, even though they are homeowners with HOAs. But if you do not pay your HOA / sometimes called condo fees, but HOA fees, then the HOA can foreclose on you. The timeline is a couple of months, and you have to be behind on your HOA fees by a certain amount. But HOA fees are nothing to sneeze at. It's crucial to make sure that you're paying those monthly dues. And there are some more typical breakdown of fees that you are required to pay in order to avoid foreclosure versus ones you're not. And we'll go into that a little bit later. But just generally know that assessments, monthly dues, and special assessments and emergency assessments, which are those one-time higher amounts, also have to be paid as well. Maintenance and repairs. These can also lead to foreclosure. If you get a repair and then an agreement for a mechanic's lien and there is a lien on your home and you don't pay it, then you can also end up going through a court lawsuit and suffer foreclosure if you weren't able to make your case there. So if you're going to ask for maintenance or repair in exchange for a mechanic lien on your home, just know that that's also placing your home at risk. So there's a lot of different things to keep in mind as a homeowner. Now let's talk a little bit about the non-judicial foreclosure process, or outside of court. So this is the basics of that. Mortgage lenders can foreclose without filing a lawsuit. Often people think, okay, well, if I'm going to lose my home, there's going to be a judge in front of me. I'm going to be able to plead my case. I'll be in the courthouse and I'll know. That's not always the case. Oftentimes it's all done paper. So they'll file some paperwork. You'll get notices in the mail. So let's say you just kind of never checked your mail, or you were out of the country for 6 months and you came back and there was just a bunch of mail in your mailbox and you never saw it, and you could be gone, not made a payment, come back and the house isn't yours. Missing a mortgage payment by 120 days, about 4 months, give or take, is the timeline of foreclosure. So it starts there. There's a notice of default that's recorded, and then there's a 3-month resolution period. What that means is that they give you 3 months to make the payment amount and bring yourself current. And if you don't do that, then they set a sale date, formerly called a notice of trustees sale date. But you'll get something in the mail that says you have a sale date coming up. It's recorded and it's posted. Usually you'll get 30 days between that notice and the actual sale date. And then the property is sold at an auction. This again, for post-foreclosure things, like there will be someone else that will send notices to your house and start an eviction proceeding, the buyer of the home. Now you have to know that they can't just kick you out. There has to be a formal eviction process if your home is sold. And your rights are the same as any California tenant. They can't just lock you out without a formal unlawful detainer lawsuit. There will be a judge involved no matter what for this type of hearing. You do have basic tenant rights. You can do cash for keys, meaning that you can negotiate saying, I'll move out on this type of day and save you the process of a lawsuit in exchange for X amount. And you can kind of negotiate whatever fee that you're amenable to. But if you do lose your home, then you do have all of the rights that a normal California tenant would have. So options to keep your home. Let's say you've fallen into hard times, you've fallen behind, right? The first thing that you can do is call up your servicer, let them know what's going on. You can fill out what's called a hardship packet. And a lot of times, if you fill out that hardship packet, they'll start talking to you about all of these options, and I'll go through them each and kind of explain them. The first one is a refinance. So this is not going to be available to you if there's a pending foreclosure and you're in default, and if your property is underwater. But a refinance is going to change your agreement completely, give you a different interest rate. So a lot of times refinancing might not be the best option because it depends on what the interest rate is currently. So if it's a little bit higher, then this might not be the best option. But it considers what you've already paid. There's also reinstatement. So reinstatement, that's a term that means you've brought yourself current. So it means that you have to do this 5 days before foreclosure. A lot of times they will not push it. You have to do it before the sale date, 5 days before. But a reinstatement completely avoids foreclosure. So if you were able to get the funds from family, or you were to sell off other assets or gather the funds in any way like that, then you ask for a formal quote reinstatement quote. So that's going to give you the full amount. That you don't just guess what it is, you ask for a formal reinstatement quote. You can also ask for a repayment plan and try and informally negotiate that. Sometimes they're amenable, sometimes there's not. You can ask for a forbearance and to kick it. Like if you lost your job and you just need a little bit of time, that's a way for you to get a little more time. Loan modification. You can change the terms of your loan. Let's say you've owned your home for quite a while and you have a 30-year mortgage. You can change the terms to a 40-year mortgage. You can just kind of extend the life of your loan. While loan modification means same lender, same everything, you're just changing the term of the loan. Refinance means could be different lender. It's a whole new application. So that's the differences between those two things there. And then litigation victor settlement is if you do decide to take your lender to court for unfair practices and you are able to get a victory there, then you would kind of go back to the shoes you were in before their illegality, and that would be a way to avoid foreclosure there. So a forbearance agreement, a reduction or suspension of payments. So halting payments for a set period of time. Something to note here, the payments are not waived or forgiven. They have to be paid. That's something that people misconstrue a lot. So it's not a pass, but it is some time that you're just given. And it does not cover taxes, insurance, or HOA fees. So oftentimes what I see is people will get a forbearance. It'll give them more time for that initial mortgage, but it doesn't give them more time for their property taxes, and it doesn't give them more time for their escrow account. So escrow will just go up and up and up, and you'll still owe that. So it's something to keep in mind there. It reduces all of the payments that you have to make and gives you more time on them, but it doesn't cover all of those expenses that you're responsible for as a homeowner. So federally backed mortgage. There are different types of mortgages here. A federally backed mortgage is just like it sounds, backed by a federal agency. And these types of mortgages are going to be Fannie Mae, Freddie Mac mortgages, FHA mortgages, VA loans, and USDA and RHS loans. Just because your loan initially started off as a federally backed mortgage when you first applied, it does not mean it's still a federally backed loan. It could have been sold after your loan was originated. So keep current and double check if you still have a federally backed mortgage, because your options are going to be different depending on if it's a federally backed mortgage or not. And then here's how you can verify if your loan is federally backed. Because if I say double check and you're like, I don't know how to do that, well, here are the directions. So here are the two websites for Fannie Mae and Freddie Mac, and you can look up your numbers or your information here and enter it and find out. You can also call the HUD's National Servicing Center line or the VA website or the RHS website and just ask, because the timelines and things are different depending on if it's a federally backed mortgage or not. What happens at the end of your forbearance period? So the period of time where you got yourself a little more time to make those payments. It depends. Now, was your loan federally backed? Who was your servicer? Who's the insurance or investor / owner of your loan? And were you current on it before the COVID-19 crisis? And the reason why these are important is because the timeline is going to be a little bit different here. And you have to look at your mortgage agreement to see what your options are. So at the end of the forbearance period, there were a lot of different rules that applied in the COVID-19 period that have been halted and no longer apply. So for instance, during COVID-19 period, that set of years, there was no balloon payments, and now we're seeing more balloon payments. So it's important to gather all of this information when speaking to your servicer so that you can tell them exactly what your circumstances are, and that way you would know better how to wiggle your way out of the forbearance without owing a bunch of money in terms of a big balloon payment at the end. So let's talk a little bit about post-forbearance options. Here are all of a little more complicated terms that we often throw around in the homeowner mortgage world. Reinstatement means to bring you current. You don't owe anything else. This is exactly what you owe and you're completely caught up. A repayment plan is you take that amount that you owe and you put it in smaller installments and you add that to your current monthly mortgage payment. So when you do a repayment plan, it's not just that it becomes smaller, it's a smaller amount on top of your normal mortgage amount. Payment deferral is it defers the repayment of principal and interest and escrow advances as one lump sum at the end of the loan. So this again gives you more time, but it's still owed. Modification, we talk about this a little bit. Modification targets a reduction in the P&I portion of the borrower's monthly mortgage payment. So what does that mean? That just means your principal and interest will go down because you're extending the life of the loan to make it longer. So instead of 30 years, you're looking at 40 years, which makes the payment overall more affordable. And then partial claim or a mortgage recovery advance. So loan insurer pays outstanding indebtedness, and that becomes a zero interest subordinate lien. So partial claims, it becomes a lien on the property, something that will become due upon sale or if you change title or if you were to refinance. But it does lower the monthly payment in that way. So let's talk now a little bit about post-forbearance loss mitigation options if you have a privately backed loan as opposed to a federally backed loan. So if your loan is not federally backed, then your repayment options are dictated by your servicer and they're dictated by the investor or owner of your loan. However, many services are attempting to offer at least one of the following. So an extended repayment plan giving you more time, a loan modification that capitalizes the missed payments, a balloon payment at the end of the mortgage. So services try to offer one of these things because they want their money. If it's federally backed, you're entitled to it. If it's privately backed, you're not entitled to it, but they will often try to work with you because if it's either that or you defaulting on it completely, a lot of times they like to keep those payments coming in and they will try and see what circumstances will help fit your situation. The clearest way, though, to know what your repayment options are, it would be to send a request for information. Again, it's that formal letter that I talked about at the beginning, an RFI. If you send that to the RFI address or the RFI email address on your servicer's website that's specifically for RFIs, and you ask them if there are any restrictions on loss mitigation options or if you have all of the loss mitigation options available to you, they're required within 30 days to send you back a list of all of your loss mitigation options. Okay, key documents for loan mods. So loan mods are a really popular option. Same lender, same terms, except for you're extending the life of the loan out, usually most commonly we see it go from 30 years to 40 years. So here's how you do that. So you fill out the 4506C form. You send over your most recent federal tax return information. You have to send proof of all household income. And a side note here, a question I often get is, okay, well, I rent a room out or I rent this out, and can I have, okay, well, this person gives me money, but unfortunately, if it's not on your taxable income, if it's not on your documents, then they're often not going to consider that because they want it to be something that they can actually see on paper, so that they're sure that that's income that's coming in. Bank statements for all accounts for the last 2 months to see how much you have and whether you're able to afford this new modification. And it helps often to fill out a hardship affidavit. So if you are in a situation where you just lost your job and you're looking for another one, and you're kind of explaining like, this is a temporary situation, I can make these payments, this is not a situation that's going to be ongoing forever, like, let's work with me here. That way I can bring my loan current again. And if you can show them proof of hardship there, that a lot of times will help your application. They want to work with you if they know that you're able to make those payments eventually. And just a extra side note on loan modifications. Factors here affect your realistic options. So are you in foreclosure? If you've been in foreclosure for a while and you're not submitting an affidavit explaining why, and you don't really have clear indication that your situation is going to change, it kind of weakens your application because they really want to see that you have a quick, solid ability to turn it around before they offer you a new payment. Are you underwater on the property? Do you owe more than you could pay? If that's the case, then they might often deny the application, unfortunately. Sustainability is a big concept that they consider. It's the need to be able to afford new payments. So they're going to offer you this new mortgage, essentially. I mean, it's the same one, but with new terms. So before they offer you those new terms, they're going to vet you thoroughly and make sure that you're able to keep those payments up. So, let's say, like, hypothetically, if your mortgage is $2,000 and they are going to start offering you $1,500 with a modification, extending life loan. They want to make sure you can afford the $1,500, because if you're not going to be able to afford the $1,500, then they won't offer you that plan. So this is kind of them doing their due diligence here. And then who is the mortgage servicer and who is the investor? Was it federally backed or privately owned? If it's privately owned, then they don't have to do this. If it is federally backed, then they do. So it's kind of something that they're always keeping in the back of their mind as well. And a loan modification application should be submitted at least 5 business days. I know I said this before, but people always forget, at least 5 business days before the foreclosure sale. And often I see people say, well, can I push the sale date back? Those are often very firm, and it's really hard to get those dates pushed. So if you have a sale date in mind, get these documents together as quickly as you can and make sure that you're adhering to this timeline, because they are not loose, I guess. They're pretty rigid here. And remember, we touched on this at the beginning, but dual tracking is prohibited. It's illegal under the California Homeowners Bill of Rights and Regulation 10 of Federal RESPA. So again, dual tracking is when they're trying to foreclose on you and they're taking steps to foreclose on you while working with you on a modification or a refinance or some kind of loss mitigation path. So if you started working with them on a loss mitigation path and you're actively trying to avoid foreclosure, it is illegal for them to take steps to foreclose it on you. And if you get any kind of sense that that's happening, or you get letters that you're being foreclosed on while they have your application for a modification or whatever forbearance, then that should be reported, because it's illegal, it should be halted, and you have remedies there. Rights of survivors. And I'm trying to get a lot of information into a short period of time, so I'm sorry for talking fast. I'll try and slow down a little bit. So we have a borrower or a homeowner who passes away, and this homeowner has surviving spouse or children who want to keep the property. A lot of times people think they can just, call up their phone, talk to the servicer, and start making payments. And that's not always the case. It's they likely won't speak to you. So another issue is if you can't keep up with your mortgage payments due to you don't have the income that the borrower did, or you don't have any information about the loan. Let's say you have no idea how long they've been paying it off, or you're not even sure what the terms are, and the loan servicer isn't going to give you that information, and they won't even accept payments from you, let's say. You need to apply to be a successor. And in order to do this, you have to fill out successor and interest paperwork. So often what helps is you call up your servicer, you say, I'm a successor, this person, they passed away. They'll ask for proof oftentimes. You fill out the packet for them, send over what information they need, and then they will start working with you and speaking to you about the loan. And the surviving spouse and child is protected again under RESPA and can make mortgage payments. And if you have problems with the servicer not applying these rules, I put them right here for you, just in case you need to send a letter. When a relative inherits and occupies the residence, then the Garn St. Germain Act prohibits the lender from enforcing the due on sale clause. So let's say there was a due on sale clause at the death of this person, they cannot enforce it if there's a successor. They can also apply for forbearance or modify a loan by showing their successor in interest. So just like the person who passed away had rights for a modification or a forbearance, so does the successor. And there are a lot of ways to show successor and interest status. You can show a deed with joint tenancy with right of survivorship. You can show revocable trust documents, a will, a marriage certificate, anything that would prove that you are related to the deceased borrower. Sometimes I've had clients show probate court orders. So it just depends on the servicer and the situation. But those are a few examples. All right, HOA basics. People love to ask about HOAs. Here's a few things that I'll go over just to kind of get your feet wet in this area, but this is just like the tip of an iceberg for a very big area of law. So California HOA rules. You have your covenants, conditions, and restrictions. This is the document that you signed when you purchased a home with an HOA. This tells you all of the rules. It is essentially a signed contract saying, okay, I'm willing to buy this home in this neighborhood. I promise and sign this contract agreeing to follow all of these rules. Another separate document that you sign when you purchase an HOA home is rules and regulations. And another one is the bylaws. All of these are governed by the Davis-Sterling Act and the California Civil Code in the 4000 section. So when you have an HOA and you're trying to look up whether something that they're doing is legal, the first place you're going to go is you're going to go to your CC&R's rules, regulations, and bylaws. And the reason is because you want to see if it's covered in the contract that you signed. And then if it's not specifically covered and something that you want to ensure, or if you want to ensure a provision of the CC&R's is legal or a provision of the rules and regulations is legal, you double check it by looking at the Davis-Sterling Act. The Davis-Sterling Act is it's a governing body rule of law for all HOAs generally. So common issues with HOAs, collections, including HOA foreclosure. Remember, if you don't pay your HOA dues, your monthly dues, or your special assessments, they can foreclose on you. It's going to be a similar about 120-day timeline, and I'll go through the process of that a little bit later. Also, monetary penalties. Let's say you parked somewhere you weren't supposed to, and they towed you, and then they issued a fee. That's where we get a lot of calls and disagreements with HOAs. Meet and confer procedure. Let's say you've asked for a meet and confer, and they're not following the Davis-Sterling requirements for meet and confer, which says if you ask to meet with the board in person, they have to respond to you and set a meet and confer by 30 days. And then also governance questions and issues like, okay, what's the law for elections, for example? That is something where you check your CC&Rs, see what the law is for, or the agreement says for elections. And then if you want to ensure that that's actually legal, then you would check Davis-Sterling, and Davis-Sterling governs elections for HOAs in California. It changes by state. So let's say that you have outstanding monthly dues or a special assessment. Let's say everybody had to have their roof replaced because it was in really bad shape. And so everyone was charged like $4,000 for roof replacement. Well, if you couldn't afford to pay that roof replacement fee and it was passed and it was voted on and there was enough people voted yes and it was legally passed and everything and there's no way to fight it that way, what will happen is you'll first get a pre-lien notice, meaning pay this or else we're going to put a lien on your home within 30 days. And the notice is 30 days. Then they're like, okay, we're filing for a lien. And then you'll get notification that the HOA has put a lien on your home. You then have a 90-day right of redemption, meaning you have 90 days to come up with this money. If not, they can start the foreclosure process, which is, kind of scary because it's just an HOA person, it's your neighbors, right? But if you don't pay this amount, this is just kind of the burden of living in an HOA community. This can happen. And there are benefits to HOAs, right? It's not all bad. The benefits are the properties are upkept well and they look nice and uniform and it keeps property values high. And, you may have amenities like a pool or, some kind of club or, someone might cut everyone's lawn, something like that. There might be benefits like that. So it's not all bad, but these are just things to be wary of. And if you don't pay the 90-day right of redemption after that, then they start the foreclosure process. I have had, people in the past ask is there anything I can do to get around this? What can I do here? So there can be success in writing a letter to the HOA asking for a payment plan. There is no obligation for them to say yes or to accept a payment plan. And it's kind of a less formal process. But if oftentimes, because they are your neighbors, they will say, okay, we'll take a payment plan. You sign the new payment plan and then you make those payments and in return, they won't foreclose. But it's very important to keep up with the payment plan, stay in communication, and make sure that you're doing everything you can not to miss a payment there, because that would be kind of the end of the line as far as options go there. So here's like a nice little drawing of the HOA foreclosure process again, after you fall behind on payments and then they record a lien, send you notice of it. Then you will get something called, just like if you miss a mortgage payment, a notice of default. So you will get that. And then after that, there will be a notice of trustee sale. Just like if you miss a mortgage payment, there'll be a sale date. And then the HOA foreclosure, again, you have up until 5 days beforehand to pay whatever you owe off, and a 90-day right of redemption. And then the deed is recorded. And then after that, it reverts to tenant's rights. And in order to have you leave the home, because you're no longer a homeowner, you're now a tenant, there will be an unlawful detainer. And then it's just like if you missed a mortgage payment there. Okay, options for dealing with property taxes, delinquent property taxes. So you can ask for a repayment plan. A lot of people don't know this, but you can ask for a repayment plan with the county's assessor's office. It does require a small down payment, 20% of the full amount due, but it's something that helps because, property taxes can be an expensive amount of money. So if you, are in a situation where you just need a little more time, it's a great option. Some cities and counties offer reinstatement assistance. I know Alameda County and Oakland do. Up north, I don't know about any in Los Angeles right now, but it's always helpful to take a look and call the tax assessor's office and ask about the area that you're in. And warning, if your property taxes are escrowed, then delinquencies can seriously impact your mortgage payment. Meaning if you don't pay these, then your mortgage payment can shoot through the roof. Meaning like 1 month it's $2,000 and the next month it goes up to $4,000 because they're trying to get you to pay these property taxes on top of your mortgage. So that's something to be aware of, and to ask for more information and a RFI, request for information, if that happens to you. Property tax reassessment. Okay. If you are transferring the property to someone else, or let's say, you want to purchase the property from your parents or they want to pass it on to you, know that property taxes will be assessed. And so what that means is that they will go up to the modern year. So let's say your parents bought their home in whatever 1985, and then you bought it from them. They're going to give it to you at a good deal, and you bought it now. It's going to be 2024 tax rates. So it's going to be much higher than if you would have, your parents would have put it in a trust or something and then kind of transferred it to you that way. So a way to be exempt from this is to put it in a trust, or make sure that there's an escape assessment appeal, which means that you fill out paperwork and you have them come over to your house and do an assessment. And maybe your house isn't worth the current tax rate, and so they'll look into it and you can ask for that reassessment. Future property taxes. Okay, check your eligibility for exemptions if you're senior or disabled. A lot of times you can get out of paying for your property taxes for the upcoming year if you're 65 or you're blind or disabled. You will have to tack a lien at the end of your mortgage, and it will become due if you sell or refinance or modify. But it's a pretty good deal because you could tack it at the end of your mortgage, and it's a very low interest rate. It's due with 5% interest. And here's the number here, and here's the email in order to get an application. If you're senior, blind, or disabled, email, call, get this application in if you're really struggling to pay your property taxes, because it can really make or break and make a huge difference. All right, reverse mortgages. These are not an option for everyone. It's a special kind of loan that lets you take the equity that you've built up over time into cash. So basically what you've paid, and then you take it out as a line of credit or a lump sum payment, depending on what type of reverse. And it's money that can pay you out in one payment or pay you out a little bit each month, and it can cover your mortgage. Basic eligibility here, 62 years old at least. And you need to own your home, have high amount of equity in it, or you need to have such a low mortgage balance that it can be paid off with the proceeds of your reverse loan. You have to live in the property. This can't be used as an investment property option. And this is a way for you, if you're a little bit, older, later in life, and just are, wanting not to have to deal with your mortgage payments, then this could be a good option, but it is very expensive. It eats up your equity rather quickly. So this is something to keep in mind. Another downside of a reverse mortgage is when you pass away, the deed of property goes to your lender, not to your family members. So this is not a good option if you want to leave your home or keep your home in the family. So there's also home equity conversion mortgages, which are insured with the FHA, and it comes with specific rules and that lenders must follow. So it would be good to check out a federally backed reverse if that's something that you are considering as an option. Okay, so let's say you've already done forbearance and you're still falling on hard times. Modification just doesn't look like a good option for you, or you've already modified and you can't get it to be a lower payment. Let's say you're on fixed income and it just doesn't look like any of the traditional loss mitigation options are happening or a good option for you. Bankruptcy should be reviewed as a last resort. Talk to a qualified bankruptcy attorney if you're considering this option. This is a very niche area of law, and most lawyers are not well versed in it. Chapter 13 allows you to keep your home. So you would need to continue to make mortgage payments moving forward while working out a plan to pay past due payments and other amounts. But the possible advantages would be to stay, automatic stay on any debt collection here. So it would strip your liens, remove any kind of unsecured debt. So strip HOA liens, if that was on there, or property tax liens, or whatever liens, strip that. But be wary of people who say they just filed the paperwork for you and then don't stick around to help you through the court hearings. Make sure if you're interviewing a bankruptcy attorney that you're making sure that they are there to sit with you at the hearing, whether it's virtual or in person, that you have representation, because that's when you're really going to need a lawyer to advocate for you. You don't need them just to do the forms. So that's something that I really advise you ask about when you're interviewing. Beware of these types of foreclosure rescue scams. Scammers are always looking to take advantage of people at their most desperate, and it's really sad. Be wary of people who set up a high upfront fee or promise to get you a loan mod or ask you to sign over the property title in order to save your home or ask you to sign anything you don't understand. A lawyer should review every term on there and make sure that you're comfortable with it and you completely understand what you're signing. Be wary of people who tell you to make payments to anyone other than your servicer. That should never be the case. And if they ever tell you to stop making payments altogether, that should be a huge red flag. If they're like, just talk to me, don't talk to your servicer anymore, huge red flag. That's usually somebody trying to scam you and trying to take your money without actually doing anything on your behalf. And if you ever have someone call you and offer this type of quote unquote assistance when it's completely illegal, then here's a page that's completely dedicated to these types of scams. And the CFPB has been really great about investigating and following up on these types of scams and bringing them to the DA's office and things like that. So home repairs are something that can be pretty expensive here. So here are some local nonprofits that have grants for these types of things, particularly if you're a little bit older. So nonprofits like Habitat for Humanity, Rebuilding Together, they have some grant programs that I know about. Government financing options. There are often city financing programs where if you qualify, you can apply for some money for some repairs if they're needed, especially if they're a safety hazard. But if you don't qualify for these grants, then here are private financing options. You can refinance, take out a second mortgage. Just be mindful you know who your servicer is if you take out a second mortgage and you stay on top of that and don't forget about it. It happens a little more often than you would think. A HELOC, which is a home equity line of credit, it's a credit card essentially that you would take out borrowing equity that you've made in your home. Oftentimes you can use that for repairs if it's pretty serious. And also, again, reverse mortgages that pay out in small amounts. So those are options. I know I've gone over a ton of information in a short period of time, and I'm really sorry. I wish I had a lot more time to go over all of these concepts. But questions, send them my way, and I'll go over as much as I can in the time remaining.
Thank you for a great presentation, Megan. So I always learn a lot at these presentations. So we have one question that came in. So how much equity do you need for a reverse mortgage exactly?
Okay. Most lenders require between 40 and 50%. I'd say lately it's been leaning more towards 50%. So you need a lot kind of paid in there. But you got to think about it this way, because however much equity you have paid into your home is how much you have to borrow back. So the more equity you have, the bigger amount that you can take out. But most lenders require you to have 50%. The older you are, you might be able to get away with a little less. The younger you are, they're definitely going to want you to have more, because over the term of your lifespan, they want to make sure that it's something that you can pull from.
Okay, great. Thank you. Is there a downside to applying for a property tax referral?
Oh, yes. Okay. So with property tax deferrals, there is a downside potentially. It does put a lien at the back end. It is a low amount at 5%, but if you have a reverse mortgage, it's not going to be an option for you, because a lot of times a property tax deferral can trigger a reverse mortgage being due. So it may not be an option. If you have a reverse mortgage, then you probably are going to want to consider a payment plan or a hardship application with the tax office rather than a full-on property tax deferral.
Okay, perfect. Thank you. I have one more question. What kind of remedies do I have for an HOA that is acting unreasonably?
This is the most common question that I get. And the big issue is that there isn't any kind of overarching governing body for HOAs. And so there's nowhere that really makes sure all HOAs are doing everything exactly the same. And until there is, the best remedy and the most effective remedy that you're going to have in dealing with an HOA is voting them out, is attending elections, gathering your neighbors, and replacing HOA board members who aren't representing your community. The thing about HOAs is you have to think about it as the tiny government that you've been set up between yourself and your neighbors. And if the government isn't being run in representation of you and your neighbors, then the best thing to do is to campaign, run yourself, have someone that you trust run, because they do have a lot of power in your everyday. So this is the most cost-effective option, and it's the most underutilized option. But it is a way, rather than paying money to try and take an HOA to court, which oftentimes if you take an HOA to court, then the HOA can charge the expense to members, and then it'll just get dispersed amongst the members again. So the most cost-effective and efficient way to handle this would, again, be to vote them out.
Mm. Thank you so much. I've heard about that. Like it's like people voting out and then someone a new comes in. But so thank you so much. Let me see if there's any more questions. Okay, I think that's it for now. So I wanted to let everyone know if anyone missed any part of this presentation, it will be available for viewing on our YouTube channel. That's youtube.com/at Los Angeles Library. Next streaming programs is tomorrow. It's the Spanish version of this program. It's called Derechos de Propietario. I'm pronouncing that wrong, de Vivienda. I'm so sorry. I will not be hosting it, but I'm sorry. So it's going to be tomorrow at 12 p.m. More information on all of our programs at the library, lapl.org/what's on/calendar. And I want to thank you again, everyone, and have a great rest of your day. Thank you so much. Bye bye.